Are prop firms really dead? In this video, I'm going to bring light into this industry and explain you exactly why prop firms are shutting down in the US, how they actually work and make their money, what their secret weapon is to lower the profitability of traders, and why their own business model is the root to all the recent shutdowns of prop firms. And lastly, why they are now even losing their MetaCross licenses, so they can't use the MT4 or MT5 anymore. Okay, let's get started with the first question. Why are prop firms shutting down in the US? The shutdown of prop firms across the US can primarily be attributed to their non-compliance with existing trading regulations, especially because they are offering CFD products to US clients, which is actually forbidden there. Unlike traditional broker firms, which have long been regulated, prop firms have operated in a gray area due to their relatively new business model in this finance industry. This lack of clear regulations initially allowed them to exploit loopholes and offer CFD products without direct oversight. However, as these firms became more mainstream, the CFTC took notice and began to enforce existing laws more stringently. The regulatory crackdown began when the CFTC filed a complaint against MyForexFunds, sending a clear signal to all prop firms. After this, most prop firms stopped onboarding US clients to avoid any legal troubles. Keep this in mind as we move forward. This is the reason number one why we recently see so many prop firms shutting down. It will all make sense at the end. Let's move on to the next point, but keep point one in mind. So, how do prop firms actually make money? Prop firms operate by charging traders a fee to participate in a trading challenge within a demo environment. And traders must successfully go through these challenges without breaching preset rules. If they qualify and pass the challenge, they can then trade on a so-called funded account. But again, also this account is just a simulated demo account. The catch here is that when a trader succeeds and earns profit, the firm must pay these earnings out of its own pocket. This model requires a constant growth of new clients who fail these challenges and lose their fees, which is then basically the primary revenue for the company to cover their own expenses, the payouts to the profitable traders, and eventually also come out with a profit. This dependency on failed challenge fees highlights the risk and unsustainability of this model, especially if the number of successful traders exceeds expectations and/or if new signups decrease. That was now reason number two, because so many prop firms are failing. They need new signups to sustain. I think you understand how it all starts to add up. If you constantly need new signups, but you're suddenly losing one of your biggest markets like the US, if you don't have enough cash reserves, this hits hard. And many prop firms already started at that point to slowly crumble down and delay payouts or even lay off employees to cut their costs. Now let's move on to their secret unethical weapon. Keep in mind, this is not proven, and I'm not saying all prop firms are using this, but according to the CFTC complaints against MyForexFunds, this was used by them. Additionally, also many other prop firms got accused in doing that. Okay, let's move on and explain what this secret weapon is. It's called the virtual dealer plugin. It's a crucial tool for prop firms to boost their profitability. This tool enables them to manipulate trading conditions to their advantage. This software allows firms to automatically change trading conditions, for example, increasing the slippage, order delays, spread widenings, and other trading parameters to give their traders less chances. Those manipulations make it more challenging for traders to achieve success, thereby ensuring that the firm minimizes its payouts and maximizes the retention of failed challenges. I know how unethical this sounds, but unfortunately this is the harsh truth what some prop firms did. Now let's move on and explain why their business model is the root to the recent shutdowns. As we already learned, the business model of many prop firms is fundamentally flawed due to its reliance on new users and the failure of challenges. This model is a bit similar to a bubble that has the risk to burst when new sign-ups slowing down. When the regulations in the US also became more strict, the financial strain on those firms intensified because they lost the majority of the market. And this, of course, led to the collapse of many prop firms because they could no longer cover their expenses. Now let's cover the last question and explain also why they are losing their MetaQuotes licenses. MetaQuotes has begun to withdraw licenses from prop firms misusing their platforms like MetaTrader 4 or MetaTrader 5 to offer unregulated trading services. That basically means that all brokers who offered their demo accounts to prop firms could no longer do that. This crackdown comes as a part of a broader initiative by the authorities. Since many prop firms are offshore, the authorities couldn't do much about them. Therefore, they started to put pressure on the companies who provide the infrastructure for prop firms to comply with those regulatories and standards. And this led MetaQuotes to the decision to revoke all licenses for MT4 and MT5 used by prop firms. The loss of these licenses is critical as it severely limits the operational capabilities of these firms, forcing them to seek less established and potentially also less reliable platforms. And again, we can see how this all comes together. Changing the infrastructure takes time, and during that period, new signups for challenges decreased by a significant amount. This again means less new signups, so basically less money for prop firms to sustain their operational costs and payouts. Okay, now let's sum this up. The prop firm industry is currently undergoing a significant change due to a combination of increased regulatory focus, which led to a smaller market. You remember, they stopped in the US. The overall unsustainable business model, which relies on new signups, and the loss of essential trading software, which again decreased the new signups during this infrastructure chain. And exactly due to those reasons, we could see the recent shutdowns of so many prop firms. But does this now mean all prop firms are bad? No, not exactly. Prop firms who know their numbers perfectly, like the average fail rate, the probability that someone will have multiple payouts, and so on, can adjust their prices accordingly to still be sustainable. One of them, for example, is FTO. They are always a few steps ahead. They basically also never lowered their prices just to be competitive. They knew exactly what they were doing to run this company profitable and to be also sustainable. But does this mean now I'm a fan of prop firms? Absolutely not. The trading rules make it close to impossible to sustain an account in the long run. I know there are many people who made decent payouts on prop firms, but trust me, not in the long run. Those rules are made like that to ensure you will lose the account at one or another point. They are maybe a great fit to make some few bucks, to fund in the future your own account, but please don't think that this is your long-term game plan, and it's also not easy. You need to be extremely skilled to sustain within their parameters, and even then you will not sustain those tight rules in the long run. Okay, that's it. Thank you for watching this in-depth analysis of the prop firm industry. And if you found this video helpful, please like, share and subscribe for more videos like that. Share your thoughts and experience with prop firms in the comments below, because I'm eager to find out how they played with you. And until then, I will see you in the next one.